Well, gold has had a hell of a run in the last year. I mean, remember, it was just lately that we were talking about whether $2,000 an ounce was going to stay resistance for gold for a long time. It had been like 4 years. It bounced off 2,000 and bounced off 2,000, and then in a very short time after it pierced 2,000, it went up to 3,000. So you could say that it's kind of overbought at this point, and we need a correction. Just because why wasn't 3,000 resistance? There should have been an awful lot of profits being taken right there, and that didn't happen. So that's out there as a risk. And then a recession where equities tank, and that pulls down gold and silver, which is the way the last two recessions happened. Both in 2008 and 2020. Equities tanked, and so did gold and silver. So that's a possibility out there. So I'm a little nervous about precious metals, especially gold, at this level, because the long-term story is totally intact. I mean, $10,000 gold will probably happen in a currency reset, and $5,000 gold is just what you would look at technically on a chart and get to without too much trouble. So the question is, what happens in the next year? And that I'm a little bit more nervous about, just because we've had such a good run already. And the oil thing that we talked about at the very start of this interview, if oil is pulled down in a recession, then that's very deflationary. And so the inflation numbers will be surprisingly low for a while. And that's not necessarily a good thing for gold. Now, having said all that, the gold-silver ratio went to 100 while all this stuff was going on. And there's, as far as I know, there's never been a time when it got up to 100 and silver wasn't a really good buy at that level as it worked out over the next couple of years. So it's possible that there's a short gold, buy silver story right now, and which I wouldn't recommend doing or anything, but it's one of those times when that might actually be a way to make some pretty good money coming and going. But I still think the silver story is really good. It's just it's a market that's in deficit, and that deficit is in danger of turning into a shortage, and that shortage could lead to panic buying. And you could easily see silver go up in $10 monthly increments for a while, where you just have this phenomenal month where it goes up by this amount that nobody really expected going in. That could happen. So I wouldn't be selling silver at this point. And if it drops down into the high to mid 20s in whatever's coming, that would be a time to start buying more. And in any event, you should be dollar cost averaging in stuff like gold and silver. The smartest way to play those markets is just not to play them, just buy a certain dollar amount per month of gold and silver bullion, put it in a safe place, and that's really almost all you need to do financially, I think. All the rest of it is interesting and challenging and fun, but if you just dollar cost average gold and silver, you'll probably be okay 5 or 10 years from now.
Well, John, what happens to silver if we get this slowdown? With let's say an industrial recession, does demand for silver go down, and that production deficit per year also, ease as part of that?
Maybe. Recessions are hard on gold and silver. And you could see short-term weakness in silver as all this plays out. But with silver, I would say that's just a reason to bump up your dollar cost averaging a little bit, because the supply-demand equation could get a little bit less dire than it is right now. But still, solar energy is a growth market regardless. And every solar panel uses a little bit of silver. And electric cars, these things, their sales could go down a bit, or their sales growth could slow, but they're probably ideas whose time has come. And so that's going to be a continued source of demand for silver. And then in the military, unless we do that thing Trump was talking about, where everybody cuts their military budgets in half, which would be very cool. But advanced missiles and microchips use silver, and the military still has a big demand for them. And, investors, when part of the reason why 90 and 100 and a range like that for the gold to silver ratio is so good for silver is that individual investors start looking at, okay, here, there's a crew grand. I have to pay this much amount for that crew grand right there. But look how many silver ounces I get for that same amount of money. And they envision this big pile sitting on a table, and it's gorgeous. And, they can use it at the farmer's market or wherever because it's low denomination money. And so people start buying silver because of the difference between silver and gold. And that usually kicks in towards the bottom of recessions, because silver will go down more than gold in a downturn, which raises the gold to silver ratio, and then people start looking at how much they can get, how much silver they can get for an ounce of gold, and then they start buying it, and then silver spends the next few years outperforming gold. So yeah, if silver goes down in the next recession, then you've still got that to look forward to, which is a reason to be a buyer down at the bottom. So, again, no guarantees about anything. There are so many different potential scenarios here, but some of them are really favorable for people who are trying to become resilient, and those are the ones we should be paying the most attention to.
Mm-hmm. You mentioned this demand for silver coming from individuals because of this, gold to silver ratio and that imagined pile comparison there. What do you think brings investment advisors to the table?
Well, that's already starting actually, because gold mining stocks tend to outperform the metals during a metals bull market. And so what's happening right now is you've had gold stocks do pretty well for the last 6 or so months, which means a lot of financial advisors have their clients coming to them and saying, hey, I keep seeing gold everywhere, buy me a gold stock, and so the financial advisor doesn't even know any gold stocks really. So they look it up and they find Newmont or Barrick or something like that, and they put their client into Newmont or Barrick. And then gold goes up a little bit more, and more people come in, and the financial advisor says, well, who else is good in that space? And so they start working their way down the food chain. And so you get generalist money start to move into precious metals via that mechanism. And that just makes precious metals miners go up even more, which sends more clients into these financial advisors. Because right now, the 70-some% of financial accounts have no gold and silver in them. No precious metals related asset of any kind. So that means there's a ton of people out there who are a little bit pissed at their financial advisor for not putting them in this thing that actually, and there are all these charts of gold outperforming the S&P 500 in this century and stuff. Mm-hmm. And so people are wondering why they have all these S&P 500 ETFs, but they don't have any gold, and gold did better than the S&P 500. And so you get kind of a snapback reaction where money managers just paid no attention to precious metals at all, and now they kind of have to overdo it a little bit to show that they're cool, that they're able to find new assets that have done well, and so maybe from 1%, those accounts go up to 3% of gold and silver, which is still minuscule. That's still nothing, but that amount of money flowing into gold and silver would send them through the roof, because those are tiny markets compared to tech stocks and financial stocks and government bonds. They're dwarfed by the mainstream markets. And so that process usually happens in the middle part of a precious metals bull market. And then it peaks after gold and silver have peaked, because people are still jumping into it. They're buying the dip at the peak, and so you still get some really nice moves in precious metals miners up there at the top of the cycle. And we're just beginning this part of the cycle, where generalist money is sort of starting to pay attention, and they're buying GDX or Newmont or something like that. And it hasn't worked its way down to the smaller players yet. So the real action is the last 2 years of the process, like 2010, 2011 last time around, when you just had gold and silver stocks just rock. And that day is coming, and that's how it will work. When the generalist money starts pouring in because of momentum, then that's when you'll want to be kind of selling some of your stuff to those guys, but we're nowhere near there yet. So continue to dollar cost average and only start selling later on when it becomes kind of a frenzy.
Mm-hmm. John, when we think about, this ecosystem of gold miners, explorers, developers, where do you focus what you're going to be putting your money in?
Well, everything in the space has its appeal. The big serious gold miners, for instance, are generating massive cash flow with gold at this price, right? Not surprisingly, most gold mines have been greenlit at $1,500 gold assumptions. And now gold is twice that high. That means that profit margins are much wider than were expected when these mines were greenlit. And so these big miners have tons of cash now. And they still remember being burned by the last time they overdid it with acquisitions and stuff. So at first, they're raising their dividends and they're buying back stock. And that's good for shareholders. That's a really nice profile for a big, solid stock that you own. They're paying you a higher dividend and they're taking stock off the market. And so that's the appeal of the big guys right now. And the mid-tiers in precious metals are looking like great acquisition candidates right now, because the big miners, even though they're paying off their debt and they're raising their dividends, et cetera, they are still running through their reserves more quickly than they're finding new reserves through their own exploration efforts. So they need to avoid just being zeroed out by using up all their reserves and ceasing to exist by going out and getting reserves somewhere else. And right now they're cautious. So they're looking at the established junior miners and emerging miners with who are way down, way advanced in the process of making a mine. So they're buying them. And that's the appeal of that group, because they're good acquisition candidates. You'll see the big guys step up and pay nice premiums for their stock. Mm-hmm. Now, way down at the bottom is the explorers. And 90% of them are going to go out of business with never earning a penny. But the 10% that actually are discovering serious deposits, the kind of thing that can move the needle for Newmont, they're still not really on the radar screen of the big guys to an extent yet, because the big guys are focusing on the safe plays, the mid-tiers and everything. But there will come a time when the market is rocking so dramatically that the big guys start buying out the little guys, the very little guys. And a lot of these little miners are really cheap relative to the gold that they have in the ground or the silver. So they'll be bought out at big premiums. And you might have, there's your 5 baggers and your 10 baggers in that space. And that, it hasn't really started happening yet on any scale, but at some point it will. So maybe it's the year 3 of the next downturn where we're coming out and everybody's really excited about everything. Or maybe it happens sooner, because the next few quarters of earnings for these big companies are going to be really spectacular. They're selling $3,000 an ounce gold right now. So they're going to make a lot of money and they're going to report really good earnings. And maybe that's the thing that kind of burns a hole in the pockets of the CEOs of the big guys. And they start buying up the explorers at an aggressive pace. No way to know the timing, in other words. But when it happens, the explorers are the place to be, because even the crappy ones are going to go way up because of the generalist money. Generalist investors are going to see some spectacular takeouts happen, where some little miner goes up by 300%, and then a big miner steps in and buys them for another couple of 100%. And the generalist money is going to want that action, and they're going to buy anything that says gold and silver in the title of the company. So the beaten down explorers that really aren't finding anything that would move the needle for any big acquirer will go up even more sometimes than the high quality explorers, because the high quality explorers have already been discovered and they're reasonably high, and the other ones have been beaten down and nobody's paying attention to them. So there's your 5 baggers or 10 baggers, although I don't recommend investing in crappy companies under any scenario, but that is the way it usually goes in this market. The names that shouldn't even exist become 3 or 5 baggers or something like that. And that gives them a chance to survive, because then they can raise money. But if the property they're exploring is just never going to make it, then they're going to waste that money too. So that's a thing for us to talk about when that really gets going, and maybe name some names of the quality explorers that you can get into reasonably safely and avoid the rest. But you want to be there when that happens, because it's just, for a year, it's easy money. It's just everything you own in that space is going up. And if you're kind of a gold bug, you have to be there for that year. So we just have to figure out when that year is.
Yeah, absolutely. How about, do you have any rules around taking profits so that you can not necessarily even maximize, but, appreciate some of the gains that you are making instead of riding it back down the other side?
Yeah, these are such volatile stocks. Okay, speaking of the smaller gold and silver miners, okay, because that's where you really have to pay attention to taking something off the table and everything. So I just have a basic rule for that. Is when something like that doubles, I just take my original investment out, and then I let the rest run unless some really dramatic thing happens with the story to change it one way or another. But otherwise, I just let it run. And it's psychologically much easier to let house money run than your personal money. And once you've taken out your original investment, what's left is somehow not quite yours. And if it round trips you and you lose everything, it's psychologically easier to handle. And then if it goes way up, you might want to do the same thing again. Take out the original and let the rest run. But there's a few like that, like Snowline Gold, to just give one example there, has just been running for a really long time. And you could have taken out your first double, and then maybe you want to take out that double again, because it's just kept on going up. But there is no hard and fast rule, and there's no substitute for understanding the company too. So you want to pay attention to their drill results, to who's making strategic investments, to what's happening in their jurisdiction. Mexico is an issue right now for a lot of silver miners, for instance. And that's an issue if you've got a little Mexican exploration company. You need to be paying attention to what the Mexican government is saying about mining stocks and stuff like that. But yeah, with the bigger companies in this space, there's no real reason to sell any of a well-managed big gold or silver miner, because they're in a bull market. They'll fluctuate along the way, but they're going to pay you a pretty decent dividend. Probably they're going to buy back stocks. And as long as they are generating plenty of free cash flow, just let them ride. Don't really try to get cute with it at all.